we're going to show you a comparison of using ULP versus a simple term insurance. And for those of us whom are not familiar, although I'm sure most of us would have heard of term insurance is a very simple insurance. It's pure insurance whereby you can buy and you can cover yourself until a certain age, say for example, term till 70 years old, or you can also buy a term insurance to cover yourself up to 100 years old, although that is not very common. Yeah, so let's take a look at the comparison between ULP versus the use of a term insurance. I'm going to show all of us using the laser pointer. Let's just get first familiar with the table. So if you look at the first broad column over here, okay, for this first column will be ULP, sum assured of $5 million, and the premium is 1.33 million. In the second column, we're going to look at numbers from buying a ULP. It's the same sum assured, $5 million, but this time around, it is premium finance. Premium finance simply means that you are actually taking a loan to pay for a portion of the premium of the ULP. So in this case, let's just say that this person takes a $900,000 loan at 2.5% per year average. I know interest rate is low right now, but as we all know, interest rate fluctuates. And let's just say over the period of the ULP, the average interest, let's say, is 2.5%. So for this person, he needs to pay an upfront cash of 430,000. So 430 plus 900 is 1.33 million. And because he takes a loan of 900,000 at 2.5% per year, the annual interest that he has to pay is about $22,500. So this is for the second column. Now, the third column would be using a simple term life till age 100 years old. Sum assured of $5 million with a premium of about $38,500. Now, just take note that for term insurance, it is usually bought in Sing dollars, yeah? But for us to do this comparison, I've changed it to US dollars. So you are actually buying sort of like a 7 million Sing dollars term policy, right? So let's take a look at the comparison between the ULPs and the term insurance. So let's say the assured upon death at age 85 years old. Take a look first at the ULP numbers. Upon death at age 85 years old, under the ULP, sum assured of $5 million, the guaranteed paid out is $5 million, right? Because that is the cover that this person has bought. Now, with a $5 million paid out at age 85, he gets a return of 3.37%. Now, I know it sounds a bit weird to have a return from an insurance policy. Now, what I really mean is that this person bought, well, this insurance of $5 million with a premium of 1.33 million at age 45. So he put in 1.33 million at age 45. We're using a 45 years old male non-smoker as an example. 40 years later at age 85, the estate, right, the beneficiary gets a paid out of 5 million. So he puts in 1.33, 40 years later, he gets a payout of 5 million, or rather the estate, the family gets a payout of $5 million. If you calculate the so-called return, quote unquote return, the return is about 3.37% per year. Now, let's look at what happens under the premium finance ULP option. So under the premium finance ULP option, the payout is still $5 million, yes, but however, he has, or the family has to pay the outstanding loan of 900,000 that he borrowed, right? Because he's only paying interest, he's not paying down the loan. So with the $5 million paid out net of the outstanding loan of 900,000, the net payout now is $4.1 million. Let's look at the return now. So he puts in what, like 430,000 plus $22,500 annual interest. Well, the return is then about 3.86%, better than the one without premium finance. Yeah. Now, so let's take a look at the term life option. Now, under the term life option, no financing, upon demise at age 85, the payout is $5 million. Okay, it's as simple as that. Now, the guaranteed return is about 5%, 5.09% to be exact. So this guy is putting in a 38,000 premium every year, and 40 years later, the family gets a payout of $5 million. The return is about 5%. Now, again, I want to emphasize that we are not using insurance payout, or we're not using the insurance instrument as an investment. Yeah, we're just calculating what is the return the family would have gotten based on the premiums that this person has put in. So that's what happens upon death at age 85 years old. Now, let's take a look at what happens upon death at age 95 years old. So at age 95 years old, upon death for the ULP without the premium finance, the payout is 5 million. Well, the return would have been 2.68%. Well, it makes sense, right? Because this is another 10 years later, right? We're talking about 55 years from the first time this person put in the premium. So, well, the return in a way has fallen, right? The best return is if you put premium today and tomorrow death occurs. That is the best return. And the longer death occurs, in a way, the return drop. I know it sounds very morbid, but that's how it is, right? Under the premium finance option, well, the payout is net of the loan. So it's 4.1 million. Then the return then is 2.75%. But let's take a look at the term life option. So for the term life option, is 5 million payout flat, but the return, or rather the return, is about 3.36%. So if you take a look at the comparison between the ULP, whether it is premium finance, whether you take a loan for it or not, and you compare to a term life, from the return perspective, now we're not looking for something with the highest return, so-called, but the return tells us that it seems like the term life option is actually more cost effective in that, well, you put in lesser and you get back in a way the same, well, paid out, right? Yeah. So the term life option seems to be the better option in terms of cost. So if I put it all together, the ULP versus term insurance, well, we can make a few conclusions, or we can compare them side by side. Well, as I mentioned, in terms of cost effectiveness, it does seem like the term option is more cost effective and the universal life policy option is more expensive. But in terms of last age of entry, okay, the advantage is with the universal life policy, because if someone is as old as 80 years old, it is quite unlikely that this person would be able to buy a term policy, whereas he may still be able to buy a ULP. So in this manner, or in this regard, the ULP is more advantageous. In terms of underwriting, the term option is stricter. The ULP option is relatively more lenient. And what that really means is that if someone has got certain health condition, when you try and buy a term policy, especially at a later age, well, the insurance company may not accept you. But with a ULP, well, there is a chance that, well, you may be accepted. In fact, if you are healthy, you may even get a discount in terms of premium when you buy the ULP. With premium finance, or in premium financing, if you want to take a loan, well, it is not possible with term, but well, with ULP, typically, well, that is how a ULP is bought. It is bought through premium financing. Well, because you take you in a way buy a ULP and it is in a foreign currency, US dollar typically, well, you have to take some currency risk. Whereas for a term policy, it is usually in Sing dollars, so you are not exposed to the currency risk. Well, if you do or use a loan, you do premium financing, well, then you have to be exposed to interest rate risk if you are using universal life policy. Yeah, but under a term policy, because you are not taking a loan for it, well, there is no interest rate risk. Well, under this option, or rather under this feature of no lapse guarantee, again, this is the advantage of a ULP. Typically, a ULP has this thing called a no lapse guarantee. Yeah, whether it is because your investment value has come down and the interest rate has gone up, there is a chance that, well, a ULP might lapse. Certain insurer provides this thing called no lapse guarantee. Some ULPs are sold on a regular premium basis, although well, most of the time what we see is single premium. Well, if for whatever reason a certain month the premium is not paid, there is a no lapse guarantee for ULP. But for term, well, if you forget to pay that premium for that particular year, 1 month later after the grace period, well, there is a high chance that your term policy may lapse. Well, in terms of surrender charges for term, there isn't any. Well, you can surrender the term any point in time, right? And that's about it, because a term has got no cash value. If you surrender it. But for a ULP, typically there might be some surrender charges. And so if you surrender a ULP too early, well, you don't get a lot of money back. So these are the differences between term and ULP. You will see that, well, it doesn't really point to which is better. Yeah, and we are not here to tell you that term is the way to go and ULP is not the way. That's not what we are saying. But what we are saying, or rather what we are trying to show you, is that, well, there are certain advantages with term and certain advantages with ULP. It is really about, what you are looking for, your needs, and what you prefer.